know everybody's kind of busy out there with harvest right now, but we really want to try and keep these markets in front of us. And so today we're going to look at some potential opportunities at the Nov 26 bean contract. Keep in mind, as always, everything we're discussing is for education and example purposes. Make sure you guys understand and know your own risk tolerance as we go through this information. What we're going to talk about today is just a simple option fence. Just as a quick refresher, your option fence is buying a put. You're going to be paying premium for that. At the same time, you're going to sell a call to collect premium. Now, why would you want to do something like this? Well, you're essentially just trying to cheapen the cost of that downside protection. As a trade-off for that, you are going to give yourself limited upside room. So essentially, you're just putting in a trading range hedge, in this case for beans. Let's get into an example here real quick. So let's use Nov 26 beans. I believe the contract's trading around 1070. Let's say you're looking at the 1040 put. It's going to cost you about 48 cents before commission and fees. So when you take that off the price of the strike, your net floor ends up being 992. And for a lot of people, that might not be very attractive. What we want to do is go out there and try and get the same level of protection, protect our downside. But what we're going to do instead is we're going to give up a little bit of upside by selling a call and collecting that premium. In our example here today, we're looking at an 1140 Nov 26 call. If you sell that, we bring in about 38 cents before commissions and fees. That would bring your net cost of the position to roughly 10 cents. So now, as you can see below here, we have a 1030 price floor rather than 992. On the other hand, you have a price ceiling now at 1130, with that sold call limiting your upside potential. Just wanted to pull this up quickly on a chart. Here's your weekly front month soybean chart. And as you can see, going back into kind of August of 24, beans just have not spent, front month beans haven't really spent that much time, above or into that 1150 area. So that's what's somewhat attractive for us here. When we're looking at these positions, we always ask ourselves, if beans go to 12, can we live with having them sold at 1140? And in this instance, considering the range that we've been on for well over a year, we think that that's kind of reasonable. Let's just take a quick look at a simple marketing program. And let's just say, it is early in the season, but perhaps you can, protect some margin in here with this fence position. So if you did 50% of your expected production on a 1040, 1140 fence and left 50% of it unpriced, we've got a little table below showing at option expiration, which would be the end of October, some different futures prices. So quickly, if you had $9 futures at the end of October, your average hedging price with this fence and then the other 50% of your bushels open is going to be about $9.65, or on 50 bushels an acre, about $482.50 per acre. And as you can see across the table, if you go to and have beans at 13, you're essentially going to have 50% sold at that 1130 net. Your other 50% is going to be up at 13, bringing you to a 1215 average, or 607.50 an acre for that 50 bushel farmer. And like we said, you just kind of got to pick, as always, you got to pick with what you live with. Now, keep in mind, this is a marginable position. So essentially, if price goes higher, that sold call is going to go against you. And if you don't have enough cash in your account, you will be asked to deposit some more money. That's how these margin calls work. So what we want to continue to do in here, things are a little bit tight across the farm board. We want to make sure that we're looking for opportunity and protecting values, whether it's protecting some of the carry of the market, or, if you're profitable at these levels, can you give yourself somewhat of a range in order to set yourself up for next year? Like we said, when looking at fence positions, these are marginable. You'll want to come up with a budget and make sure that you're aware of how these positions work. And then lastly, what can you live with? For us, it's always a very simple question anytime we look at putting something like this on. If beans go to 13, can we live with having some at 1140? If you cannot live with having some beans sold at 1140, this is probably not a good position for you, because that's exactly what you're signing up for when you put some of these on. Now, keep in mind, we wouldn't recommend doing this on 100% of your bushels, but you could certainly consider doing it on a third, a half, 2/3, whatever you're comfortable with. We just view that this is a decent risk management strategy as we go forward into next year. If you guys have any questions, feel free to reach out to us. More than happy to help. As always, please like the video, subscribe to the channel. We always enjoy making the content for you. God bless.